short-term pain, but actually for quite a lot more medium to longer term gain.
Hello from Frankfurt am Main. We're here today talking about European equities with Tom Hara from GAM. Hello, nice to have you.
Hello there, thanks for having me.
Yeah, you are managing a European equity fund, and Europe had a couple of tough years. Always US equities were outperforming. Would you say that European equities now could have a comeback in 2026?
I think that would be subject to world events. We know that Europe as a continent, as a society, is strategically weak. You look at energy prices, you look at supply chains, you look at our lack of defense capabilities, but we do have a lot of companies that are going to do very well, given the direction of travel the world is going. You know, we've got lots of expertise across many industries. And so I think it's important to separate the companies, the equity market, the asset class from Europe as a society. And on that basis, I'm quite positive, especially looking at the valuations. It's always been true that Europe is cheaper than the US. But certainly the companies that we own, we're combining strong earnings prospects with those low valuations. So I think for investors in equities who should always have a positive disposition about the potential risk-adjusted returns on offer, Europe's a really attractive asset class on that basis.
You mentioned the dependency now with the war in the Middle East. We see, of course, a big dependency on oil from Europe. Would you say this war in the Middle East could be a setback for European equities if this especially goes a bit longer?
It already has been to an extent. You know, we've seen that the market has entered a risk-off mood. Actually, since February, we saw a movement into more what are historically regarded as defensive sectors. I actually don't think they're very defensive at all. That's probably something we can come on to. I think it has further demonstrated the areas that Europe as a society needs to invest in urgently and significantly. And so on that basis, yes, there's always a short-term technical risk-off driven behavior to equity markets, but actually events in the Middle East, and again, certainly for the companies we own, for the portfolio shape that we have, it's further bolstered the case for these companies to see quite a strong cycle on a 5 to 10 year view, and therefore quite strong earnings growth. So I think short-term pain, but actually for quite a lot more medium to longer term gain.
Did you adjust your portfolio, or maybe what are your biggest positions at the moment in your portfolio?
So I would say, to simplify our portfolio, there's a new acronym doing the rounds called HALO, and it's hard assets, low obsolescence. So this is things that are strategically critical in a new multipolar world. That's defense, it's semiconductors, it's raw materials, and it's also businesses that are less likely to be disrupted by AI. So think, software is currently in the crosshairs of disruption in terms of how the market is treating software stocks. So this HALO acronym represents anything that is hard assets, low obsolescence, safe from AI, likely to be strategically critical in the years ahead. And that is a very significant skew for our portfolio. So we came into this conflict already positioned in that way. We've seen no reason to change that portfolio shape. What we have done is opportunistically added to areas that we like as the market has had this technical sell-off. And I would say the most notable one is oil field services. They were already clearly having a strong cycle because of previous years of underinvestment. But if anything, the outlook now looks even stronger for these companies, certainly once they're allowed to re-enter or restart work that might have currently been disrupted due to conflict in the Middle East. So oil field services is the one area where we've opportunistically taken up our positioning. And that certainly fits under the HALO umbrella.
And of course, you're not the only fund investing in European equities. There are a lot of European equity funds. What are you doing differently regarding your peer group?
So versus the peer group, we're a small team at a boutique house. There are three of us. We're a very tight-knit team. That allows us to remove a lot of the behavioral jeopardy that goes with big teams, big asset managers, lots of internal politics, lots of process. And that process often doesn't serve the end client because it slows decision making. It can create emotional attachment. It can create the wrong incentives. If you're a young analyst and you spent 2 weeks writing a report, preparing a slide deck to present at an investment committee, you may defend that investment case in a way that is not entirely objective and therefore not entirely in the best interest of the clients. We don't have any of that. We're a small team of 3. Again, we're not defending a big back book that is in the interest of a big corporate. As a small team, we get to adopt all of the latest AI tools. We have to. We don't have a large desk of analysts who are working day in, day out on models and handwritten reports. We use tools that effectively replace analysts, to put it bluntly. And that allows us to get up the knowledge curve quickly on stocks. It allows us to debate them sooner and make decisions quicker. The final thing I would say is we are truly active. That is something that shouldn't need stating, but it actually does in the industry today. Usually when you look at our portfolio, we will be around 80% active share. So we're taking proper views within the European equity market, and we're positive on the prospects to deliver good risk-adjusted returns for people who want to invest in equities and who want to invest in European equities.
So optimistic for European equities with the halo investments and a small but concentrated team, says Tomohara from GAM. Thank you very much.
Thank you.